Welcome, welcome back to this channel. This is Unfiltered Forex with me, Clement, and I am here for the CPI forecast. Today's Wednesday. The CPI is coming out tomorrow on Thursday. I am doing this forecast now. Later in my day, I'll be occupied doing some other stuff. So let me just do this now. Let's begin. First, here we are. Economic calendar. Let's look at CPI expectations. First, the core CPI month-over-month figure is expected to come in at 20 basis points, 0.2%, the previous being the same as the previous number. Yeah, we're expecting that to be flat. The core CPI YOY expected to come in at 4.7%, a slight decrease of 10 basis points from the previous reading of 4.8%. CPI year over year, this is the headline CPI, all items included. We're expecting that to tick up a bit to 3.3%, up from last month's 3%. CPI month over month, July, expected to tick up by the same degree as the previous month's number, 0.2%. And as you can see, the CPI month over month change for all items is expected to be the same as the CPI month over month change for these. Core CPI month over month change. Okay, first let me talk about this one. Naturally, what you would expect is why this reading is expected to come out above the estimate, above the previous reading, is because last month's reading we had an amplified base effect. If you watch the previous video where I was talking about the CPI forecast for not the the CPI breakdown for the previous month, the CPI breakdown for June released in July. In that video, that's where I talked about this base effect. Why the headline CPI year over year number came in at 3%. Yeah, you should go watch that if you didn't. So it's only natural to expect that this time the number might tick up a bit, and it's going to break the streak we've had for about 11 months. Is it 11 months? Yeah, I think the CPI Y over I has been cooling. Yep, it's 11 months since July last year when it peaked. It has been coming down ever since, coming down, coming down, coming down, coming down. Yeah, so this time if it comes out above the previous number, it's going to break that 11-month streak of consistently coming out below the previous reading. So yeah, that's it for that one. Now let's go to the good stuff. When you want to forecast what to expect in these CPI numbers, there are some leading economic indicators that can help you determine if this CPI is likely to come out above estimate or below estimates. Currently, this is the estimate. If you want to know whether these estimates are reasonable enough, there are some factors you need to consider. First, as you have heard me talk about, is this one, comparing this year over year number. Why it's expected to tick up a bit is because of last month we had the amplified base effect. That's why this reading is expected to come out above the previous month's number. It's not bad news. If this one comes out at 3.3%, yeah, it's going to mean inflation is still cooling, but only slower, and that's reasonable. So let me go to the economic indicators, leading economic indicators that I use to determine if this CPI, if any other CPI, will come out above or below the expectations. Number one, ISM manufacturing and non-manufacturing purchasing managers index. That's the PMI. If you're trading in these markets, you obviously know about the PMIs. Purchasing managers index, a very useful leading indicator for overall economic activity, and also a very useful leading indicator for for employment and prices. Yeah. First, let me look at the ISM report. This is the report itself, right? You can see the website link here. I'll leave the link in the video description. You can check that out. Services PMI, manufacturing PMI. This is the services PMI for the month of July, both services and manufacturing sector. This is the report itself. As you can see, it's a very detailed report with, yeah, with explanation, a quick summary of what the index is doing. So yeah, it's a very detailed report, and it's a very useful leading indicator for the economy as a whole. So here, what you're going to look out for is the month over month change. Yeah, this is the percentage point change for from the previous month. This is the series index for July. This is the series index for June. This is for the services sector. This is the series index for July. This is the series index for June for the manufacturing sector. You can see it's divided well enough. Yep. When I was talking about the NFPs, we did talk about the employment index, but that's not what we're talking about today. Today, our focus is on the prices index here. This line, as you can see, going. Yeah, this is where we are. Let's go. Yeah. So the prices index for the month of July, month of June. This is for the services sector, 56.8 versus the previous month number, which was 54.1, an increase of 2.7%, which is kind of risky, which is bad news during this time because we don't want to see inflation ticking up like this. This is a month of months change, by the way. So if inflation is rising, this is already this high. Remember, if the number is above 50, it shows it's increasing, and being above 50 and even above the previous number, it means it's increasing, and now it's increasing faster. That's bad news for inflation, of course. And remember, the services sector, this is the sector that all prices are, not all prices, but most of the prices are consumer price index, the basket of goods. These are prices that are kind of concentrated in the services sector. Another one, this is now for the manufacturing sector, 42.6 for the month of July. 42.6, and the previous month's reading was 41.8, an increase of 80 basis points. So this number being below 50, it shows prices are dropping, but this number being below 50 but above the previous reading, this shows prices are dropping but slower. So the month of month change, you're likely to see an uptick, but it's still likely to be low. This is for the manufacturing sector. The the manufacturing sector the price index in the manufacturing sector is what's considered a leading indicator of the services sector because this is the goods. This is all the goods that are used in the services sector, they come from the manufacturing sector. So if prices are dropping here, you can expect them to also be dropping here. Currently, that's not materializing because, as you can see, this trend has been going on for 74 months. For 74 consecutive months, this number has been above 50, and you can see it's not showing signs of slowing down currently. So yeah, this is this is just the raw analysis of the index itself. We have seen the prices are increasing in the services sector, but prices are decreasing but slower in the manufacturing sector. Going back to the going back to the calendar, there are things you need to look out for, right? Here we are. This is where we are. Now you have to compare the expectation with the outcome. This is what's going to tell you what you're likely to expect come during the CPI, because if this is what the market was expecting and this is what we got, that of course means the market was wrong. Plain and simple. That means the market was wrong. And yeah, for the non-manufacturing price index, we can see prices here came in higher, a lot higher than the market expected, and even was even higher than the previous number. If you look at the report itself, the trend in change months, yeah, you can see it's kind of going back to where we were in May. And yeah, for the month of June, there was a real downtick in the price index, even though it was still above the forecast. It was it was still below the previous number, and that's what that is what was good news at the time and indicated that the prices are still rising but slower in the services sector. Now this number came in above the forecast and even above the previous one. So this is trouble for the month over month changes CPI, of course. Then of course we need to look at the ISM manufacturing price. Yeah, comparing the actual to the estimate. The market was expecting 42.8, but the index came in 42.6, as you can see here. It's in red, meaning it was below estimate. This is kind of good news, but it's just a slight miss, meaning it was largely within the expectation. So this can just call it, can just say the outcome was as expected because yeah, the market, this is what the market was expecting. 42.8 versus the actual outcome of 42.6, still above the previous number of 41.8. So yeah, this means trouble for the month over month price changes. As you have seen here, the month over month changes for both for the core CPI and the CPI headline number, they're expected to remain constant. But what we're seeing so far from the ISM PMIs is that, yeah, it's likely to come out above the estimates or at estimates. That's what we're seeing. The possibility of the numbers coming in below estimates is quite low for now. Okay, that was it. That's the first leading indicator you need to look at for the CPI, the ISM services, the ISM manufacturing services PMI. Second one is the durable goods orders. The durable goods orders are important because they tell you about the consumer demand, right? They, mm, of course, inflation is pushed up by demand. If there's high demand for goods, if consumers are spending, that's likely to push up prices. Yeah, this is basic economics. Durable goods orders. I prefer to look at the durable goods orders because these are big purchases, right? These are big purchases, and as you can see here, this is, yeah, durable goods orders month over month for the month of June. Core durable goods orders month over month for the month of June. Remember, these are orders made to the factories by the purchasing managers, the store managers. They are the guys making these orders to companies. So if they're making these orders to companies in the month of June, that means these goods were delivered in the month of July, right? You get. So if this number is high, this means in July, consumer demand was likely high. I hope you got that part right. For example, let's say for example you own a shop and you're selling cars, and you're seeing people are buying a lot of cars, and it is likely that you're seeing that next month you think you're going to sell more cars, right? So you're going to go to the factory, make an make an order for more vehicles to be delivered to you, more than the usual amount, to be sold in the next month, not in the current month, in the next month. So yeah, this is a leading indicator of two things, mainly consumer demand and thus a leading indicator of prices. If demand is high, that of course means prices are also likely to increase. We're not going to go deep into the details analyzing this one. As you can see, this number was very high above the estimate and even higher than the previous one. And you can see even the previous number was revised higher to mean there was higher demand than initially expected. So yeah, that's something you need to watch out for. Continuing, if you remember, by the way, this day, this Thursday, 27th July, there was an extreme volatility in the dollar pairs because of these releases. This durable goods orders coming out this high, and even in addition to that, these are the numbers. The dollar index was just rising and rising. Yeah, so that's it for this one. Durable goods orders as a measure of consumer demand can tell you what to expect with the CPI numbers. This time, this number is not exactly good news for inflation currently. The last leading indicator I will look at, that I usually look at when I am trying to see what the CPI might do, is, of course, the oil price. The oil price. This is US oil, WTI, Western Texas Intermediate, I think. Yeah. The oil prices, of course, are a big contributor of inflation. And as you can see, for the month of July, this big green candle, is showing a 15% increase. Yep, a 15% increase in price of oil for the month of July. So that, of course, means this increase was likely transferred onto the consumer and spilled over into the whole the whole economy, meaning prices likely ticked upwards in the month of July. So this is showing, yep, comparing the previous month's increase of just almost 4% and this month's increase of 15%, almost 16%, by the way. It's very likely that the month over month change in the CPI will this big increase is likely to be reflected in the month over month change in the CPI, because as you can see here, oil has been cooling for the past 12 months. Yeah, for the past 12-13 months, the the oil price has been falling. And you can see here in June, when the oil price peaks at $120 per barrel. The month of June. This is also the month where the CPI was the highest at 9%. Let's look at that. Yeah, this you can see this candle is for the month of June 2022. This is where the oil price peaked at, yeah, $121 per barrel. And you can see here on the CPI for the month of June last year, that's where this this thing really peaked. Is it June or July? Yeah, this is where the reading was. You can just go down here and check. Show more, show more, show more. Yeah, this is website. If you watch the video I talked about economic calendar I use, you can see why I prefer to use this one over the others. It's very easy to use it. Yeah, you can see the CPI reading released on July for the month of June came in at 9.1%. And you can also see for the month of June, this is where the oil price peaked at $121 per barrel. That this time, that's also likely to be reflected in the month over month change, especially if the oil price ticked up this high. This is the biggest increase we've seen since this increase. Yeah, this is the biggest rise in oil prices month over month since this decline started. And yeah, it's not something you can ignore. This is very likely to be reflected in the month over month figures, and in turn, the month over month figures going to affect the overall numbers, the year over year figures. So that's it. Those are the three main ones I prefer to look at: the ISM manufacturing and services PMIs, durable goods orders, and of course the oil prices. So as you have seen, the expected outcome here, it's not looking good for inflation numbers here. We are likely to see numbers above estimates, especially for the month over month figures, due to a rise in consumer demand and also a rise in the oil prices. So yeah, even the year-over-year number for the core, if this one comes out above estimate, like 4.8% and 4.9% probably, that's very likely to be bad news for these markets and very bullish for the dollar index, because that's going to mean the Fed is likely to deliver another rate hike to keep inflation at bay. That was it. Let's Now let me look at the dollar index. Now that we have seen these numbers are likely to come in at estimates or above, the possibility of the numbers coming in below estimate is quite low for now. Let's look at the dollar index. First, this was my expectation for the CPI. No, not the CPI, the NFEs. If you watched the previous video, we're talking about the NFE breakdown and what I've used. Yeah, that's where I was expecting this downtrend to kind of start and continue falling from here. But now, these CPI numbers are likely to push the dollar index upwards, probably probably to these highs if the numbers come in high enough. Yeah, if it's going to depend on how the market is going to interpret those numbers. We're likely to see the dollar index pop up, break past this trend line, and just go, and just go revisit these highs. Looking at this on a smaller time frame, what are we seeing? Let's look at the 4-hour time frame. Oh, So first, whoa, something interesting here. I don't know why I had not seen this. Let's first take this out. Something interesting here I am seeing is like this is just not a retracement, right? If this move started and price is now almost taking out this high, it's likely that this is not just a retracement, it might be a reversal. Just put a simple trend line here, and like that. You can see price seems to be consistently bouncing off this trend line, and even now it's still doing that. And it's likely that this thing is not a retracement and it's a reversal. Price is likely to just start skyrocketing from this point. And considering that tomorrow is when we're getting the NFP, no, the CPI, you're likely going to see a big move there. I was going to say this is a flag, but no, this flag is flags are not big patterns, right? Where is that? Yeah, this is the one I use. I was going to say this is the flag, like you just do that, and you can see that sequence of price forming higher highs and higher lows is the general pattern of a flag. But flags are not this big. Even if they're valid, they're not this big usually. A flag is usually a small pattern, and the retracement is mostly within the previous impulse. You can see this is the impulse we got during the NFP. If this flag was actually valid, I think it wouldn't have gone this high. This is very likely to be a full a full reversal of price. Yeah. So that's it for this. That, of course, if you know what this means, if you understand the dollar index, you know what this means for the euro, dollar, the JPY pairs. Yeah, let's look at the euro, for example. Here we are. This is the euro USD pair, and as you can see, this price is generally in a downtrend, falling, and it tried to pick up during the NFP move. This move tried to kind of reverse the direction, but it just wasn't enough. You can see price is now falling again, and now we got a retracement, and it is likely that this is a retracement for price to continue falling. We're just going to watch and see what's going to happen, such that by the time the CPI is being released, which is tomorrow at 12:30 noon GMT time, we're going to see what price is going to do at the time. Between now and then, of course, price will have presented a setup and you're going to know what to do. Yep. So I think that's it for now. I have nothing else to say. Have a lovely week and I hope you kill that CPI release. Hope you do good. Thanks.